Hi, this video is going to look at the impact that taxation and government spending can have on the economy and, by extension, businesses. So we have looked at this before. This is the circular flow of income, and we measure the size of the economy by the flow of money that's going from businesses to households and back again. We call this the circular flow of income, but the economy isn't quite that simple. Okay, it's also affected by banks, the government and abroad, and particularly we are going to be looking at the impact that government can have on the size of the economy, because the government takes money out of this circular flow of income when they charge people tax. But the government can also put money back into this circular flow of income when they spend money. And so what we're looking at today is called fiscal policy. Edexcel don't actually use that term, but that's what this is. Fiscal policy is the use of government spending and taxation to influence the level of economic activity, the amount of money that's flowing around the economy, in other words. So the government can do two things, okay? So if we think of this economy like a balloon, and when the economy is getting smaller, the government wants to put air into the balloon. They want to expand the economy. What they can do is run what's called a budget deficit. And a budget deficit is when the government injects more money into the economy than they take out in taxation. Okay, so they run a budget deficit. It's a deficit for the government because they're spending more than they're getting in, but it boosts the economy. So it's a bit confusing because the government is running a deficit themselves. They're putting more money into the economy than they're taking out, but it's expansionary for the economy. They're blowing up the balloon because more money is going into the economy. The alternative is if the balloon is getting close to popping, all right, if the economy is going a bit too fast and we're starting to see inflation creeping in, the government might just want to take a little bit of pressure out of the economy, withdraw a little bit of this money, and they do that by charging people more taxes, people and businesses more taxes. Okay, so the amount that the government withdraws from the economy will be greater than the amount of money the government puts in, and that's called a budget surplus. It's contractionary. You're stopping the economy from going from expanding too quickly, all right, and it might be done because the government's concerned that the economy is overheating. So what can the government do? So there are two sides to fiscal policy, and you need to know about taxation and spending. So let's have a look at taxation first. Broadly, there are two types of taxes. Indirect taxes are taxes on people's and businesses' income, all right, and they affect incentives to work. So we've got income tax on people and corporation tax, which is earned on businesses' profit. So income tax is charged against people on the amount of money that they earn on a personal basis. Corporation tax is on businesses' profits. Indirect tax, on the other hand, are on spending. Okay, they affect production and consumption choices, and will include things like VAT, VAT. You've probably heard of that, and duties. So duty-free in the airport doesn't have any duty on it, but things like cigarettes, alcohol, things like that do have duties charged on them. Okay, so the government. Let's just say they want to boost the economy. So what would they do? They would cut tax. They take less money out of the circular flow. So what happens if they cut direct taxes? So if they cut taxes on people's incomes, well, people go out and work more, right? Because they get to keep more of their money. So that's good for the economy. People want to go out and work more because they get to keep more of their money. That means new workers enter the workforce. Workers are likely to be highly motivated because they're keeping more of their money, right? So we can see how this would be good for businesses, right? It increases the pool of workers. That might help to enable them to reduce wages because there's a higher supply of labour, basically. Businesses are also going to have more profits because corporation taxes fall, right? They get to keep more of their profits, which is an incentive for new businesses to enter the markets, right? If I'm thinking of starting a new business and the government cuts corporation tax, brilliant. It means I get to keep more of my money. If I'm an existing business, right, and I get to keep more of my profits, well, that's an incentive for me to invest, to take risks, to try and earn more money. So we can see how all of these things would boost the economy. What about if they boost those taxes on spending, the indirect taxes? So if they cut those taxes, if they reduce VAT, that would mean that selling prices get cheaper, right? And people go out and spend money. It's going to give people more disposable income. It should increase sales. So that boosts the economy. Also, if businesses don't need to pay duty on things like fuel and stuff like that, that can reduce their costs of production, incentivize them to increase output. So all of this is very, very good for businesses. Okay, but what about if the government, so we said that fiscal policy, right, it's taxation and spending. And if the government wants to boost the economy, right, government spending has to be less than taxation. So it's all very well cutting taxes, but the government might increase spending on as well. Okay, so what would they spend their money on? Well, the biggest area of government expenditure is welfare. Okay, pensions is the biggest area, but also job security, and increases in welfare benefit the least well off. Okay, so that creates benefits for businesses. The least well off in society, if you give them more money, they go out and spend it. Whereas rich people will save their money. So this can be very good for businesses. They might want to change their product portfolio and focus on those people who are getting higher incomes because welfare has gone up. The government might spend more money on health, which is great for businesses because they should have a healthier and more productive workforce if the government's spending more on hospitals and doctors. Okay, the government spends money on schools, so if that money goes up, there should be an increasingly skilled workforce. Businesses spend less on training. This is great news for businesses. Defence is an area of spending, like spending on the armed forces. Well, you might think that how's that going to benefit businesses? But, armed forces, they require ancillary services. They require people to, make sandwiches for them, supply uniforms, supply equipment, all of that kind of stuff. So there's going to be lots of opportunities in support industries. The business might spend more money on infrastructure and transport, same thing really. Okay, infrastructure, systems that we need like roads, broadband. If the government spends money on these things, great news for business because better transport and internet. So, taxation and spending, it's called fiscal policy. It's an influence on economic activity because the government can either put money into the economy through spending or take money out through taxation. And you need to think about how these two areas affect businesses.